This is Kristi Sullivan with Sullivan Financial Planning. Thanks for watching my video. Today's video is an accompanying talk to a blog interview that I did with Renee Cohen of Coldwell Banker, talking about real estate trends that she sees in late 2020 going into 2021. And with buying a house, usually, of course, comes the question of how to finance it. Or maybe you're thinking about refinancing a house now that interest rates are so low. A question that I often get has to do with whether or not to use a 15 or a 30-year mortgage. And I have to say that my bias very generally is to use the 30-year mortgage. And it's not because I think you can make more money in the stock market than you can interest that you're paying on the loan. It's really not about arbitrage or beating the interest rate with market returns. I mean, who knows from year to year whether or not that's true. On average, I do think it is true. But my rationale more has to do with liquidity and flexibility in your payment. For most people, your house payment is your biggest bill. And if you go to a 15-year mortgage from a 30, although the interest rate will be lower and you will save on interest over time, you're locked in to an almost double the amount of mortgage payment that you would have for a similar 30-year mortgage on the same property. So that's all well and good when things are good, when things are going well for you, your job is intact. But what if you or your spouse loses a job and money becomes tight? And now you're locked into that larger mortgage with no recourse. I like it if people, if it's your intention to pay off a house within 15 years, fine, go ahead and double up a 30-year mortgage payment yourself and make it a 15-year mortgage. Yeah, the interest rate will be a little higher, but you have the flexibility if things aren't going so well, or maybe, hey, your kid starts college and you're like, geez, I'd rather pay more for the college tuition right now than have this huge mortgage payment. My point is, by locking yourself into a lower fixed necessary mortgage payment, of course you have the possibility to pay more on principal and shorten that loan when it makes sense for you. But you also have the possibility to go to the minimum mortgage payment if you need that extra flexibility in your finances. Thanks for listening. I hope this was helpful.